The coming economic disaster. This is something perma bears think is going to happen all the time. I'm not a perma bear. I'm more perma bullish, if you will. I think you do not want to bet against the US economy long term, but let's face the facts. You have not went into an actual recession since 2008, 2009. Now is the time. You're starting to see some real problems. I'm not going to call for sell everything, we're imminently going into some kind of recession, but I'm growing more concerned by the day almost. And the problem with some kind of recession or economic slowdown is it happens quickly. For an example, on September 29th, 2007, I had to pay $25 to read you guys this headline. Just by the way, this is how serious this video actually is. It reads, consumer spending rises, easing fears of a slowdown. Personal spending rose a better than forecasted 0.6% last month, the biggest uptick since April, led by strong sales of durable goods. And if you look at the S&P 500 back in this time period, really September, you had come off of a decline. This was an initial decline from July 2007 until the low of August 2007 of about 12%. But by September, things were looking more optimistic with consumer spending, and you ended up rallying from the lows to October 10th, around 15%. So you actually got back to a new all-time high on October 11th. On November 8th of 2007, Bernanke warns Congress of an economic slowdown. Bernanke at the time is like Jerome Powell today, the chairman of the Federal Reserve. So in about 5 weeks, you went from consumers are spending money still to Bernanke was warning the Congress about an economic slowdown. And then just 2 months later, on January 14th, 2008, this article reads from CNBC, Americans cut back sharply on spending. And by this point, the S&P was back to really where you were during the summertime of 2007 with resurging recession fears. So within 3 months, you went from economy strong to 5 weeks later, the Fed's warning Congress about a slowdown, to a month later, and consumers are cutting back sharply on spending. Now, back in 2007, right around July or so, when you started, let's pull up the S&P again, when you started to see some of this initial decline before you did retrace and hit new all-time highs, during this period of time, you were really starting to see a lot of companies doing what? Warning about the consumer. This article on October 23rd, 2007 reads, consumer stocks tumble as slowdown looms. Companies from IHOP and Coach, as well as Walmart and Target, are reporting that consumers are slowing down their spending, especially in the, you guessed it, lower quadrant of a consumer. These are low-income consumers. Which, even if you look back to May of 2007, this individual, Andrew Wolf, retail and consumer sector analyst at BB&T Capital Markets, told CNBC Squawk Box that consumer spending is far from dead. And they had something similar to kind of what we've seen this year as well. April sales were better. March sales came in well above expectations, and then April was worse in some different metrics. But hopefully by now in this video, you're seeing the trend here. This article from April 30th, 2024, so not that long ago, says McDonald's and other big brands warn that low-income consumers are starting to crack. Now, I will let you guys in on a little bit of a secret, and really the first big warning that I got in my real life firsthand about the consumer, and it was, of all places, when I was getting my haircut. See, here's the secret. I don't go to a barber I don't go to some random, haircut place. I go to a female salon because they're the only ones I've found that can actually do it right, that listen to what you say. What's crazy about it, I get there and the doors are locked. The place is not open on a Tuesday afternoon, literally like a month ago. And when the lady got there, she said they're only coming in to do their appointments. There's not a lot of walk-ins. And as she was cutting my hair, we were having this conversation, and she was telling me that business is less than half of what it was a year ago. Now, why that's important is because it's a salon. And a month ago is when, everyone got their taxes back. Month and a half ago, whenever I got my haircut last. Pretty recent. And she was saying the females she's heard from are just trying to catch up on payments. All their taxes are going towards other things. And tell me right now that these moms out here are not going to spend some of their taxes, $200, on getting their haircut and getting their, highlights, whatever they're doing. They can't afford that. You have massive problems under the surface here. Walmart's CEO just said, quote, "It is clear that broad-based consumer pressures persist around the world." Not just in the US, but around the world. Consumers continue to be even more discriminating with every dollar they spend as they face elevated prices in their day-to-day spending. Executives at 3M just said, quote, "Continued softness in consumer discretionary spending." Coca-Cola's management has seen a greater emphasis on value, saying the purchasing power of lower income consumers has taken a hit. If Coca-Cola, a company that sells $1.50, $2 bottles of Coca-Cola for the most part, is warning about the consumer cutting back and taking a hit, we have a problem on our hands. You have seen similar warnings from Walmart, from Target, from Starbucks and Dollar General and many other companies. Hundreds of companies are warning about the consumer. That's step number one. It happened the same way in 2007. Step two is it starts to get reflected in the data. We're getting to that phase now. Take a look at the data that came out today from the Michigan Consumer Sentiment Survey. The headline number was forecasted at 78. It came in at 67.4. Huge misses across the board here. Michigan consumer expectations were expected at 77.3. You came in at 66.5. What? Wow, that's just a crazy miss. Same is true for Michigan current conditions. You were expecting 79.5. The actual number came in at 68.8. Another huge miss, while inflation expectations did rise in the 1 year period ahead from an expected 3.1% to 3.5%, and 5-year inflation expectations were expected to stay at 3%. They actually ticked up to 3.1%. You also had initial jobless claims that came in yesterday, the highest in almost 1 year, going back to August of 2023, as well as last month's non-farm payroll number that came out last Friday that came in about 60,000 jobs lower than expected. Now, I don't want to say now's the time to sell everything and get out of markets, because I think you're a little early for that. But I think it's a prudent time to start paying very close attention to what companies are saying, but the state of the economy. I made this poll on YouTube. If you did not see this already, it's got 500 votes, so I think we got a big enough pool to go off of for now. Go ahead and vote. And keep in mind, this channel tends to be more bullish, okay? It tends to be optimistic about the economy, about inflation, about Tesla, and whatever else we cover. We just tend to be more optimistic than not. Doomsday preparers in our markets don't tend to do well. The economy tends to perform over time. Now, this post says, how does the economy feel to you? I just wanted an overall general consensus of how we're doing out there. 7% of you guys said great, spending a lot still. 30% of you guys said it's okay. 56% of you guys said bad, cutting back where I can. 7% of you guys said lost my job or I'm scared I might soon lose my job. This is hopefully an eye-opener for everyone. It was definitely an eye-opener for me. I was expecting the biggest category here was going to say it's okay. Now, I'm in this category. It's bad. I'm cutting back where I can. I am, yes. Like, literally, cutting back where I can. And to be honest with you guys, instead of every day getting takeout from different restaurants, getting pizza, more expensive items, I'm making peanut butter and jelly sandwiches, tuna fish sandwiches at home, just to be able to save that, $20, $30 a day to get as much cash as possible, because that's just the time that we live in. The same sandwich that cost $10 in 2019 costs $22 today. So definitely not splurging as much anymore, specifically on food. That's where I have really made the biggest cutback. Let me know where you have cut back the most down below in the comment section, because apparently 55% of us have started to cut back in some areas. Now, I'm obviously an investor, so I'm trying to cut back so I can plow more money into the markets if this recession event does actually take place. And let's be honest, I think it's a matter of when, not if. But judging on where markets are, investors are looking at a possible recession, not, when, but if it happens. Like, it may not happen. We may not see any kind of substantial slowdown. And, well, when it happens, it may never happen. That's kind of how stocks are looking at this situation with a consumer slowing down and a possible recession. That's just judging off of the markets almost at all-time highs. What's actually pretty interesting about looking at 2007, 2008, and today, just comparing the two, which you may have never heard this before, but at the time, there was a lot of talk about energy inflation slowing down consumption. And that was true. Energy, oil specifically, hit its highest level you've ever seen back in 2008. Doesn't that sound quite similar to what we're experiencing today? But today, it's not just gas prices. It's prices for everything. Take a look at this. It says, this is Tex Pitfield, who owns a petroleum distribution business outside Atlanta, says he is not renewing the leases on 4 of his 20 trucks because business has slackened, especially in areas directly connected to residential real estate. Quote, "We are not running any fuel to the construction companies for new home sites, the guys that put in the sewer lines and the utilities," he said. "Big block stores are down in consumption and retail consumption is down. Some of that may be related to rising energy prices. Oil prices this week topped $80 a barrel. Now they continued up to $140 a barrel. But the point is, then there was low inflation overall. Lots of inflation in energy markets. But again, today, there's a lot of inflation everywhere. Now, if you want my personal theory on the situation is what's different from 2007, 2008, and today is today, the last couple of years, there was a lot of stimulus that was sent out. Lots of free money basically everywhere. I mean, you could be a dog and you got a stimulus check. You could be in prison and you got a stimulus check. Okay? There was a lot of money out there. That takes some time to wear down consumer spending behavior. If you give a teenager $10,000 and say, do what you want with this, I mean, they might hold on to some, they're going to spend some, and it's going to take a little while before they're out of money, okay? But they're going to be spending. And if you give everyone, call it $10,000, there's going to be some inflation out there. Now, that's what happened. The other part of this, so just to be clear, that's why I think you haven't seen a recession yet. You haven't seen a material slowdown reflected in the data. You're starting to, that's for sure. That's obvious. But that's probably the reason it's taken so long. The other aspect to this is companies were flushed with all of this money that people were spending, and they said, oh crap, we have to meet this consumer demand. A lot of companies built new buildings, new plants, new assembly lines, new restaurants, upgraded old restaurants. I know a lot of that was happening, especially with restaurants that survived and did well during the Rona. They all expanded to meet this excess demand that they were seeing. And it was all artificial because people were given free money. So you've seen an overinvestment in artificially inflated areas. That's also going to be quite problematic. And the reckoning to that could happen when you get a more material consumer slowdown. Now, if you look at this chart, this is from the data today, Michigan current economic conditions. You've seen that huge drop, right? From 79 down to 68.8 today for the month of May. You're getting back, I mean, you're basically in your 2008 global financial crisis area. Now, in November, you actually hit a lower point than the 08 Great Financial Crisis at 53.8. But again, I think that was back in 2022. I think a lot of that was the different components of this survey that were going into it, like stock market readings. Based on what the markets do, that affects this quite a bit. And that's why this is pretty notable to me, is because stocks have been doing just fine, and you just seen a big plummet in current economic conditions. This article from May 6th, 2024 says reports show early signs of an economic slowdown. They point out ISM business activity in the service sector that was fluctuating between 55 and 60 for more than a year until the month of April. This number just came in at 50.9, almost in full-blown contraction. And I think this article is even more damning. It says this forecasting tool is sending its strongest warning since the Great Recession. It could signal a big move in the stock market. This is the Conference Board Leading Economic Index, and it has fallen sharply from its record high. This index incorporates 10 economic variables into a single number each month. You have average weekly hours worked by production workers in manufacturing, average weekly initial claims for unemployment, new consumer goods and materials orders placed by manufacturers, new orders placed by customers of manufacturing firms, new non-defense capital goods orders, excluding aircraft, placed by manufacturers, building permits for new private housing units, changes in the S&P 500 index, changes in proprietary credit index comprising 6 financial indicators, interest rate spread between the 10-year Treasury and federal funds rate, average consumer expectations for business and economic conditions. So a crap ton of different things are incorporated into this one number. This article says the Conference Board LEI has been a relatively reliable recession forecasting tool since 1969. Whenever the LEI has declined at least 5% from its peak, a recession has generally followed within 21 months. There has only been 2 exceptions to that rule. The first exception was July 1981 recession. The LEI had yet to recover from the January 1980 recession, meaning it never had a chance to decline 5% from its peak. The second exception is the current situation. The Conference Board LEI last peaked in December 2001, which was 28 months ago and counting. And this is a chart of the peak before a 5% decline and recession start dates and the time eclipsed between them. 21 months was from March 2006 until the recession start date in December of 2007. This was a 21-month period. Today, it's already been 28 months. I think, again, back to my argument of all of that excess capital out there in the economy, that artificial capital out there in the economy, is probably why this is taking so long. But when you actually do start to get a slowdown in the consumer that is represented in data, it's already been a long time in the making. And you're starting to see that. When it happens, it can go quickly from here. Not saying it's going to, but if it does, you have like 3-4 months until you could be in a full-blown recession. On average, stocks fell about 21% after the first Fed rate cut since 1970, says Comerica. But if you actually enter a recession, stocks tend to fall about 31%. But again, by the time you're already defined in a recession, you're 6 months into a recession anyways, because a recession's 2 quarters of declining growth, you're already at or near your lows. So by the time the government says, hey, we're in a recession, the markets are already going to be done, sold off by then. Now, this article came out on February 6th of 2024. Comerica says, quote, "This is because in normal times, the risk of recession was usually imminent, prompting monetary policymakers to ease conditions. Unfortunately, their timing was typically off, and by the time the Fed acknowledged the need for rate cuts, a recession was already underway." Now, the reason I even started looking into all of this information to make this video was this article. It's from May 10th, today. The Fed put is back, and that's great news for the stock market. Now, here's what the Fed put is in English. It's not literally saying go out and buy puts on our markets. The Fed put, the terminology became popular in the 70s, 80s, 90s, 2000s to say, hey, if we start to go into economic weakness, the Fed's going to bail us out. The Fed's going to cut rates. They're going to do quantitative easing. They're going to do whatever they have to do to bail out the economy, which is generally true. Now, the Fed put becomes a little bit more difficult when inflation is high, because normally if you go into a recession, inflation's going to fall, but then you're already in a recession and there's no Fed put there, right? The Fed put is a put to keep you out of a recession, basically is the best way to put it. The Fed's going to bail you out if you start to go into a recession. Barron says the Fed put is back in our markets. But judging off what I heard from the Fed today, it doesn't sound like that. Judging off of the data that we got this morning with the Michigan Consumer Sentiment Survey, with the miss to the unemployment rate and the non-farm number that we got last Friday, with the ISM services number that we just got that came in bad, with companies warning about the consumer, hundreds of companies this earnings season, you would think the Fed would be a lot more dovish than they were today. I mean, Fed officials are still talking about if the economy is sufficiently restrictive. Yeah, Fed Logan says, there are uncertainties if policy is sufficiently restrictive. Fed Bowman said we need to keep policy steady for a bit longer. Fed Logan says it is not a soft landing yet. Well, that's good to hear the Fed acknowledge that. Fed Logan said it's too early to think about cutting rates, and the strong economy could be a sign of a higher neutral rate. It says the neutral interest rate level may have risen, and this is a big reason why 10-year Treasury yields are back up almost 6 basis points today. None of what was said there gives me any confidence about the Fed being able to precisely identify the moment they should start reducing rates. Honestly, I think that moment is now, like last meeting. They probably should have started reducing rates. Because again, by the time the damage is done, it is too late. By the time you're actually getting recession fears in the markets, which is not yet, it's too late. You're already going into recession at that point. And I think just, again, if I'm some guy that can sit here and say, people got way too much money, businesses invested way too much, and people are now pulling back. I mean, 55% of you guys say you're cutting back where you can. Go into your local restaurant, unless you're in, some kind of huge tourist location, and just look around. Go there every day for a week. Ask people how things are doing. They're going to say it's terrible. It's slow. It's the worst we've ever seen. I've been doing that in my area of Michigan. People are getting less hours, if not outright just losing their jobs because companies overhired based on fake demand. And now people are feeling the pinch from the cost of living. This mortgage in this house I'm in right now is up like $300, like 35, 40% from the original mortgage that I had just since 2021. That's just one example. Car insurance, among food and others. It's outrageous. So really, in a nutshell, consensus of this video. While I don't necessarily think it's time to sell everything and get out the markets, you're definitely seeing some problematic things that are very reminiscent of 2007, 2008. And I have zero confidence the Fed will be able to identify when they need to start cutting rates. I think that moment is probably already now. They should already be starting to reduce rates right now, and they're not doing that. Now, if you take a look at the NASDAQ, for an example, you're sitting at almost all-time highs. The markets are not priced for a recession, that's for sure, let alone even a larger consumer slowdown. Whereas companies are literally telling you, people are not coming in as much. They're getting cheaper products. I mean, who else needs to tell you that? Walmart's telling you that. McDonald's is telling you that. Companies you and I all know about. So again, consensus is you don't need to panic. You don't need to sell all your stocks, but you need to pay very close attention. And honestly, I wouldn't blame you if you did sell a chunk of your portfolio to get some cash ready on the sidelines. Warren Buffett is about as bearish as he ever gets, with almost $200 billion in cash in his Berkshire bank account, and just sold a chunk of his Apple position. Next week, we are going to get data, CPI data, and retail sales data that will come out on Tuesday. On Monday, you are going to get a speech from Fed Jerome Powell. So we'll see next week. We'll have more information. But again, you want to be very, very attentive to what the data is and what the broader picture looks like for the economy going ahead. But just to, again, be very clear, we've never had another instance in time where this much money was printed and given out to people and subsequently seen high inflation, the Fed have to fight that, and then kind of in this situation now, like how much did we overinvest? How much of that overinvestment was truly just artificial or fake demand? I don't know. Is the Fed going to be able to thread the needle for the economy and balance the risk between the economy weakening and inflation? I don't know. I'm not convinced of that. Good news is a stock like a Tesla, in which I'm sure a lot of you guys are invested in quite heavily if you're watching this video, it's already down a lot. You're much better priced for some kind of broader recession, okay? Small caps are pretty well priced for a broader recession. They haven't done that well. Look at SoFi, look at Fubo, look at Tesla, look at PayPal. All of these stocks are already in the dumps. To some respects, they've been priced for a recession for a long time. The broad markets, other areas, not so much. And that's a little bit more where I'm concerned about. So stocks like a Tesla, like a PayPal, a Fubo, a SoFi, I'm personally invested in all of those companies, and I have no interest in selling any of those because they're already beaten down so much. But hey, what do I know? Let me know down below in the comment section. What do you think about the economy right now? What do you think about this information presented to you here in this video? Again, I'm not expecting a lot of people are going to agree with this. I really don't care if people agree with this or not. This is a definitive fact. The consumer is slowing down. You can see that everywhere. It's starting to be represented in the data. This sounds very reminiscent of 2007. When companies started warning about the consumer, and then 3 months later, it was everywhere. Consumers slowing down sharply. And the Fed was warning Congress about a potential upcoming recession. So these things can happen quickly, and I think we'll have a lot more clarity in the next couple of months. I think it's time to raise some cash as quickly as possible and get ready to go shopping when markets do come down. I think it's not really a question of if but win. If it's not this year, due to the election being this year, and it's very much political suicide to have markets sell off and go into recession during an election year. So maybe it's early 2025. Maybe I'm just really early on this video. That's a possibility. And honestly, the longer it takes, the more cash you can build up, the better position that you will be in. Nonetheless, guys, I have went on and on long enough. I could keep going. There's a lot more to share with you, just comparing now to 2007, 2008. And obviously there were differences here, but I think it's a lot more similar than you would think. Nonetheless, hit the like button, subscribe to the channel. Let me know what you think about this information down below in the comments section. You guys have a great rest of your day, and I will see you in the next one.